Hello, I'm Grace Pan at the NUS Business School, and I'm here with Dr. Robert Merton. He's the Nobel laureate for economics and also professor at the MIT Sloan School of Business. He's also the resident scientist at Dimensional Fund Advisors. Dr. Merton, so nice to see you here today. I wonder if we could begin with talking a little bit about your latest research and your latest findings. I'm going to call it broadly connectedness. And I think you're finding in your research that the financial markets in various sectors are more connected now than perhaps they were pre-crisis in around 2008. Is that fair to say?
That's a correct statement of what appears to be the data, but the way I think of the research is the following, that as we've seen in this crisis, that there's an interaction between different financial institutions, banks with insurance companies and so forth, but also with banks with sovereigns and sovereigns with institutions. And this degree of connectedness among them, principally in my work, focused on their connectedness in terms of credit and credit risks, because that was at the center of the crisis. You and I could do a lot of business together and we would be connected, but we may have very little impact on our credit viability. So we're just focused on credit is the work that I'm doing now in terms of this connectedness. And the idea that you're referring to is that it appears through time that the degree of connection in terms of the influence of one institution on another, institution on a sovereign on an institution, in terms of their credit. So if the sovereign has a credit problem, does that create a problem for the bank? If the bank has a problem, does it create a problem for the sovereign? And the degree of those connections and the number of them and the strength of them does change through time as different conditions evolve. And as you said to me, it appears that prior to the crisis, if you looked at a kind of a heat map, very pretty colored structure of all these connections, and then you looked at that same map during or after the crisis, it's much denser, which would, as a picture, be conveying to you that the connections among all these institutions are certainly stronger, closer together, and can go in different directions and change the way in which they go through time. So the key thing to understand is these connections are not going to remain the same. They keep changing, and so that's why we have to monitor them. And as they get more connected, that's not necessarily bad, but it tells us potentially that there's a greater vulnerability. Because as your common sense would say, if we're all very tightly connected, if there's a shock, it may be that it'd be a little more stable because we're so connected, but often that means that the shock can propagate in very, unintended or unanticipated ways through the system.
So, as you say, it's not necessarily good or bad. Is this something that's desirable? Is it something that you would want to mitigate, or is it something you should, or one should mitigate, the policymakers, okay, whoever the decision makers might be?
When I say it's not either good or bad, it's a description of the circumstance we're in, and you can be either more vulnerable to shocks or less vulnerable. That's a description of the way things are, not good or bad. I mean, it is what it is. But then in terms of your question of what could you do about it, that's a very interesting question, which our research has not yet gotten to the stage where we could answer that as any kind of a scientific conclusion, because it may well be these changing connections occur, and even if we see them happening, that they have happened, this vulnerability, it may be that there's not anything really we can do about it. I didn't say we can't, but I can't say, oh, well, we see that, let's undo it. It may not be possible to do that. If you want an analogy, to the extent that you think these are vulnerabilities, and they don't always have to be, but if they are, it's a little bit like if you have a hurricane that you know is coming. You could ask the question, is there anything we can do to stop the hurricane? I think most of us would say today, no. But there are things we can do knowing it may be coming or we're vulnerable to it to try to protect ourselves more, be aware of it.
Well, in practical terms, if as an investor, one were trying to build diversification into one's investment portfolio, how would you actually achieve that?
That's a very good question, and it's certainly the case that everything else the same, if you have a higher degree of connectivity, that sets up the potential of creating correlations or connection which mitigates or goes against diversification. That said, one has to be very careful to recognize that if the financial system secularly is actually becoming better globally, isn't it nice to talk about something being better instead of everything being a problem or a change? But suppose it's getting better, which I believe it has been over time. I'm not talking about the crisis, but more larger horizon. It has gotten much better. One of the effects of that is that in the past, when we had less well-functioning financial systems, different parts of the world, different countries were less connected. That made them more independent, but it meant that there was very poor diversification, because that meant all the people over here were not getting the benefit of the diversification of the people over here and vice versa. Do you see that? So diversification would say what? These people should get a bit of what these people have, and these people should get a bit of what these people have. Do you see that? They're both better diversified. You agree? Mm-hmm. But now what happens, because these people now own something that these people do, and these people own something that do, what's going to happen when there's a change? They're going to move more closely together because now they're sharing. So the very act of diversification, the thing you want, has the effect that you can't sell the same piece of real estate twice. If you've done perfect diversification at the extreme, which we haven't done, then everything's going to move together. And you're going to say, oh, we can't diversify anymore. The answer is, we have done it. It's just, you can't get the benefit twice. You see? So I'm not saying that, that the usual way that in these times of nervousness, that these connectivities are moving together isn't a worry. But I also want to caution you that it also is a sign, potentially, of things getting better in the way the system's working. And that's why you need to look at the actual data. You have to look at what's driving these things. You have to apply the science to these things seriously. You can't sit here in an armchair and say, oh, they're moving together, therefore we have a contagion system or something that sounds very bad.
From what I can see, when you are talking about connectivity, you're talking broadly about sovereigns, the government, their connectivity to, for example, banks, financial institutions, to corporates, to individuals. And then there are also, of course, state-to-state connectivity. So when you look at this universe, can you share with me which are the areas that are especially enhanced in connectedness, and which are the areas where you see the least amount?
On which day of the week? That's the whole thing I'm trying to say. It's not quite that bad, but it changes. So there are periods of time, let's say during the crisis. In March of 2012, that's a year ago, during the year, the year of the US elections, early in the year, if you looked at the United States, as big as it is, the largest economy, the Federal Reserve, the most influential central bank in the world, you say, well, it has to be connected to all this. Actually, in terms of credit, it had very little influence, nor was its credit being influenced by much of the rest that was going on. Now, it's always a bit danger to speculate on reading the tea leaves, especially early on, but just to give you some intuition of what that could mean, or why that would make sense, is in an election year, given the election term, it's very unlikely that the United States would make a major commitment, expenditure to aid the credit of Europe or anywhere else in the world, just because of the political situation. So it was going to have probably very little influence on the credit issues in Europe and at the time. On the other hand, in March of 2012, there was very little concern, I think, in the world that the U.S. was at credit risk. In fact, it's probably a safe haven, and we saw where funds came. So you can understand how, even though it's big and important, at that point in time, it wasn't a very important part of it. At that time, also, the UK was actually not part of very much of it, and then less surprisingly, Switzerland and Sweden. And I'm just giving you these examples. At other times, it could be very much more connected. If we look within the Euroland, Italy, Spain, and so forth. Greece, even in the five, Greece, Ireland, Portugal, Spain, Italy. At times, they were highly influential. That is to say, what happened to Greece or what happened to Italy was appearing to have a big influence on the credit of both some other sovereigns, but also banks. At other times during the crisis, it was going the other way. So you have, a very transparent case in the case of Ireland between bank and sovereign. Ireland, as a country, at one point early on, guaranteed all the banks of Ireland. Well, what was the effect of that? The credit rating of those Irish banks went up because now it had the backing. But the credit rating of Ireland as a country went down because they had said, we are going to stand behind all of these banks in euros. So you see, I'm trying to give you intuition from example why those connective things can change both in directions. Sometimes the sovereign is affecting the bank, sometimes the bank's the sovereign. And then you get a very interesting thing that's called feedback. And so we sometimes don't just have the influence going in one direction, but we can have a two-way influence going on at the same time. And these are the kinds of things that we try to measure in the system to better understand what's going on, and importantly, how that's changing. See, again, I can't emphasize enough that these connections vary and change and go back and forth, particularly when you move from times of relative calm to extremes. But even within the extremes, they change. So there's no simple answer. There's an answer to every question. Unfortunately, it's not the same answer, so I can't tell you in general.
I'd like to try to make it, a little bit more tangible for a lot of the people who might be watching this discussion. Some things in the financial markets are perceived to have inverse relationships. For example, certain assets might price when they move up, other things might move inversely. Yeah. So from the point of view of a portfolio manager or just a mom and dad investor, from what you can see from your findings, what are those relationships that currently exist? I guess we have to put in a time frame that currently exist that do have those inverse relationships or do have the least amount of connectedness.
If I tell you that the U.S. looks very unconnected to this, then that would suggest, would it not, that as a European or not even where you are, that you're likely to get more diversification from this source, from at that time moving into U.S. assets, okay, than in another time when it was more connected. So the answer, I'm going to be very concrete, but I'm not saying go and buy U.S. because the U.S. is unconnected, because that changes. And there are many other factors. But the way the tool can be done in the way you're asking the question, it's not inversion. There are very, very few real economic things in the world that are negatively correlated. Generally, economies are related to one another. There's so much interconnectedness of our businesses. It's very hard to find something that actually moves in opposite directions, okay? Sometimes they used to say gold does that. The reality is with the data, it doesn't. It's not reliable at all in that regard. But it's very hard to find these great diversifiers that go the opposite way, okay? So, but less correlated, that they don't move as well. That's one way you could use the tool, is to say, when you appear to see less connectivity between the sovereigns or the sectors, if you're investing in the financial sectors, you can look across the interrelationships among the various financial institutions to see how sensitive their credit is, which affects lots of aspects of it. So that would give you a measure of changing correlation. And from those changing correlations, you then could determine how you might use the tool to change the way you mix these. But I want to underscore there are many other aspects that go into this estimation. There's not one tool you use, but that's how you could use it for that purpose.
You are starting to suggest or propose that there should be an integration of monetary, fiscal, and financial stability policies. So in that context, can you give me your assessment of how well the U.S. government is doing in that respect, in terms of the policies that they've taken post the 2008-2009 crisis?
I would say for the U.S., but I think for most of the others, that the standard approach, I believe, is how it's done, is that you have monetary policies looked at by the central bank, fiscal policies is taken place within the government administration, and then perhaps in another part of the central bank or in the oversight, you have the stabilities. And while each of them communicate with each other, I believe generally they don't coordinate. So for example, I don't believe, I could be happy to find out otherwise, I don't believe in many of the monetary policy decisions that there's an explicit recognition or taking into account the impact that may have on financial stability. So let me give you a concrete example. In the United States, as you well know, as in many of the other countries, UK for example, a policy was introduced to bring interest rates down very low. Not only short-term interest rates, but all the way to the long-run interest rates, brought them down very low for the last 5 years. And really until the last couple of weeks, that's been pretty much the policy. And the argument is that that will help stimulate things and so forth. But one of the consequences of that, but really two, but one of them that I want to bring up is that the entire pension industry, who have promised pensioners to pay them a certain amount of money in the future when they retire, the amount they've promised them is fixed. What it takes to fund that depends on interest rates. If you have high interest rates, the amount of money you need now to fund it is less, because you can earn more on your money. If you have low interest rates, the amount that you need is much higher. So the implication is that if I have promised a bunch of pensioners money in the future, don't change that. If interest rates fall, as we did, it causes the liability to go way up. And unless they had assets matched to it, which they don't and haven't, they find themselves in a situation in which, as a consequence of lowered interest rates, liabilities going up, you now find the whole pension industry, not private pensions only, but public pensions, having enormous underfunding, which is a stability issue. And one, of course, that's been discussed quite a bit, both in the United States and out. I would say that's an example where you would like to have, or believe, that in thinking about the monetary policy of lowering rates, especially long rates, to try to stimulate business cycle investing and consumption, ought to be considering the impact that's having on financial stability through this impact of the interest rates on something that's not really related at all to what they have in mind. And the same thing is true with fiscal policy. I would say this, to my knowledge, that that's not done in a really integrated fashion, and that it should be. And the models that are used, I believe, while they've been long used, and I'm not being critical of what they are not models that include embedded in their structure risk and uncertainty. And as a consequence, they, from a financial stability point of view, from the impact of uncertainty, they are not likely to show up in their modeling. And so I think we're at a stage of the world where we need to have that the policy decisions need to be done in an integrated way with integrated models that take account of the interplay not only between monetary and fiscal, but monetary, fiscal, and financial stability, and consider all of that in the making those policy decisions. And I would say, while this is a tall order, it's not going to happen overnight. Two, the good news, I believe, is one, we have some pretty interesting tools from which to do that. So I would put it as not in the realm of pure science to be done, but more in terms of engineering. We kind of know how to do it. We have experience doing things with these risk tools in private sector, but it's a big job and a complex job to integrate it. So it's an engineering problem, not a science problem. So that's good news. The second is that I have seen among central banks, ministries of finance, various other official sectors, as well as very large asset managers, but I'll just stick with the public sector, around the world, a lot of interest in doing this. And I think the big interest is coming principally because of need. But so I would put that as a plus. Not being done now, I don't think, but I think we're moving in a direction will eventually find its way in, and I think that'll be very much better for public policy.
So the pension overhang is a big worry. I think there's also general anxiety in the marketplace, questions over whether or not we might be heading for a relapse, because a lot of the core problems that precipitated the crisis, have they really been addressed?
Are we vulnerable to a relapse? Of course. Do I think we'll have one? If I had to give you a guess, I don't think so. But that's not worth very much, because it's not what's the most likely thing to happen, it's what could happen. So of course there is vulnerability. But in terms of your question of what we've done, what we haven't done, I think we've taken some steps. Some steps were self-corrective. I think a lot of institutions have on their own, quite aside from any policy decisions, have changed their behavior and what they're doing, and have dealt with some of the excesses. And so there's some amount of that. I think the idea of trying to put as many derivatives as you can on central clearing on an exchange is a good thing, but it's not a panacea, because the main problems were not derivatives in this. There are much many more problems. What I can't tell you about, because I just don't know, is what the plumbing is like. So we know in this crisis, it was a credit crisis, but it was also one of the plumbing of the money system. So repo markets and money market funds, and all these sorts of they're not at all rocket science, sexy stuff. It's just the plumbing of how we ran into a lot of trouble, and I don't know, because I just don't have the knowledge, how much we've done to kind of fix that. I'm hopeful we have, but that's a good question. You should probably be asking some people who are in that part of the industry. And it's important, because often some of the biggest risks and vulnerabilities are not in the exotic things. We always like to think it's the new and exotic things, but are in the relatively mainstream plumbing or documentation. I think they've gotten better at documentation, but that was one of the big problems in the crisis. Nobody knew what they owned, so it's hard to know what they were worth or what risk they had. One has to be cautious that we're far from knowing the answer to that. And I think everyone's feeling certain frustrations, such as the uncertainties that are still out there in the US with Dodd-Frank and all the decisions. Here we are 3 years after it was passed, and still a lot to do. So I guess as a report card, I say I'm cautiously optimistic, but I think there's a lot of uncertainties there. I will say that what's complicated, you mentioned the pensions, is this issue of interest rates, because if you take the United States, and I think you'll find other countries are in similar circumstances, if interest rates go up, as they have in the past few weeks, that will mitigate the pension problem, because it'll bring down the liabilities that I described to you and up. That's the good news. But at the same time, the US has to overturn its debt, roll over its debt. It has $12 trillion in publicly held debt. The rest is in the Fed. If roughly half of that, that's a ballpark number, rolls over every year, that means $6 trillion would roll over. If interest rates, and it's not a forecast, if they were to go up, let's say, by 300 basis points, that's 3%, so from 2% to 5% or 1% to 4%. That would increase the interest bill on that new debt by 3% of $6 trillion. That's $180 billion. 10 years of that, which is the usual way you see that's $1.8 trillion. So I don't want to scare anybody, but you understand that the system is such that if rates move, we may get some benefits, let's say in the US in the pensions if they go up, but we're going to then have a aggravation of the budget issue for the federal government. And so it's worrisome. I'm not, you know, I can't say much more about it, but there'll be challenges here to address this. But I think everybody understands that that's the case. And so, you know, it shouldn't come as a surprise to anyone that we have these challenges that have to be met.
A lot of food for thought. Thank you so much, Dr. Robert Merton.
My pleasure.